I was recently reading about a strategy to trade the S&P 500 which uses 5-minute bars, and it used the first 2 5-minute bars of the session to determine the direction of the market for the rest of the day. This video isn't going to investigate that strategy, but that strategy prompted the idea for the strategy that I am going to show you in this video for euro dollar. Rather than using the 5-minute bars, I'm going to use daily bars. And I thought, how about using the price action of Monday to determine the direction of the rest of the week? After playing around with the rules a little bit, and actually in one case reversing them, I actually found something that works pretty consistently over 13 years of data for euro dollar. Firstly, I'm going to show you how to get in and out of these trades, what behaviour to look for on that Monday bar. Then we'll have a look at the different versions of the strategy, and then the final version, which uses in-sample and also walk-forward optimization. The object of this video is not only just to show you this working strategy, but also to show you how to come up with your own ideas, or in this case, to actually take something you've seen and then modify it, try it on a different time frame and a different market. And this is what algorithmic or rule-based trading is all about. Testing lots of different ideas until you eventually find things that do work and show us where there are some edges to be had in the markets. So let's go over to the whiteboard and I'll show you how to get in and out of these trades. Okay, so daily bars, euro dollar. And we want to be paying attention to Friday's bar and then the next bar, which will be the Monday's bar. Okay, just those 2 bars. And particularly, we want to be observing Friday's open, so here, and Monday's high and low price, the high and the low. Now, I've actually shown a short setup on the board, and for a short setup, what we want to see is the high of Monday less than the open on the Friday. Okay, so it looks like we've got some short-term momentum to the downside. And as soon as we see that, as soon as the bar's closed on Monday, we want to go short. We're going to enter immediately at market. And of course, the opposite is true. Let me just do a little diagram. We want to see the open of Friday. Let's say this is Friday, the open here. Monday, we want to see the low of Monday higher than the open on Friday. So we've got a bit of short-term momentum to the upside, and then we go long as soon as the market closes on the Monday. However, when I was testing this with euro dollar, I noticed it worked particularly badly. So I done what I thought was logical and I reversed the rules. So now I'm saying if we see some short-term momentum to the downside, rather than go short, we're going to go long, and that worked way better. Exits for this strategy, the initial idea was to determine the direction for the week. So I thought it's logical, let's just get out of the trade at the end of the day on a Friday or the end of the week. So we're going to test that, and then we're going to look at some other exits which actually work better. We're going to be using a fixed pip stop loss, and I will be running an optimization for that on some in-sample data, and also using walk-forward analysis or walk-forward optimization to find the best stop loss value. In fact, the stop loss value is the only input or variable that we're going to be optimizing on this strategy. So let's go and have a look at each stage of the development and see how I've improved it along the way. All the testing is done using IANDA data back to January 2008 through to December 2021. Apart from where I use the walk-forward optimization to find the best stop loss, which uses data from the 1st of January 2012 through to December 2021. And I've included some costs. I've included $60 round trip, or which is equivalent to 6 pips of euro dollar. In this first workspace, you'll notice that I've actually marked up 2 of the bars, and we see the first thick white bar is the Friday, and then the next one is the Monday. So we can see that every week, okay? Friday, Monday, Friday, Monday. So looking at this trade here, we're looking at Friday's open, which is whereabouts my pointer is, okay? And then Monday's high and low. Now Monday's high was less than Friday's open, so that's our indication to short the market on the open of the next bar, which is just a few minutes after this close of this Monday bar. Okay, let's have a look at this trade here. On Monday, we see that the high is higher than the open of Monday, just down here. So we go long. Okay, and you'll see that the exits, we've got these end of day exits, and you'll notice they're on the Friday. We get in the trade just after the close on Monday, and then we hold until the close on Friday. And at the moment we're going with the momentum. So if Monday's high is less than the close on Friday, we're looking at short-term momentum to the downside, so we've shorted. So let's have a look at the results. And that's what the equity curve looks like, which is pretty awful, but quite nicely awful. So that's what prompted me to reverse the rules and see what happened then. So let's do that in the next workspace. Now in this workspace, you'll notice that same day, that same trade is actually now a long trade, and this one is now a short trade. So we've reversed those rules. And let's have a look at the equity curve. So straight away, look, much better. I'm making 38,000, not making that much money, but the equity curve is definitely moving in the right direction. In the next workspace, we're going to forget about that Friday exit. In this workspace, all we're using is a stop and reverse exit. So an exit from a short trade is when we get an entry to go long, and vice versa. If we're already long, then we don't exit a long trade until we either hit the stop loss or we get a signal to go short. So let's have a look at what the equity curve looks like. Okay, it's not much better, is it? Making slightly less money. Long trades, pretty terrible. Short, it works better on, but it's not that great. At the moment, we don't have a stop loss, so that's what I want to try now. And I've optimized the stop loss from 0 pips, that's no stop at all, through to 800 pips, so I've gone quite wide, and I've gone in steps of 50 pips. So looking down the net profit without a stop loss, like we just saw, we're making 36,000. And this is one of the rare occasions where the stop loss actually really improves the results on the strategy. And we can see quite quickly that we've got decent numbers. We've got 60, 79, 74, 66. So we've got some quite stable areas around here. 400, 350. So let's use a 350 pip stop loss and see how that works. Well, we already know it's making 79,000 rather than 36. Looking at the equity curve's much nicer. That's actually quite pleasing. And like I say, it is one of those rare cases where a stop loss has actually improved the strategy. Looking at the equity curve close to close, we can see the green dots, new highs, which is quite nice. Total trade analysis, we've got quite a large average trade at $335. Don't forget, this is already including some costs. Percent profitable, about 60%. Average days in the trade is about 15. Now we have that basic strategy programmed, and I've been using the daily bars. After that Monday bar is closed, we will have the signal or not. If we have the signal, then we take the trade on the open of the next bar, which normally is fairly immediately, but depending on your broker, it can be anything from 1700 to 1715 Eastern Standard Time. The problem with trading at 1700 or 1715 is the spreads can get quite wide on some of these Forex pairs. Euro dollar, the narrowest actually, but they still can widen in comparison to what they normally are. So to combat this, I've actually reprogrammed the strategy using a smaller time frame, using a 15-minute chart, and I'm entering trades at 16:45, so 15 minutes before the market closes. Strictly speaking, we haven't seen the high and the low of that bar yet, but the vast majority of the time the high and the low won't change within that last 15 minutes, and we're going to avoid the big spreads on the market at and around the open of the next bar. And I'm pleased to say that even on the back test, just entering that 15 minutes early actually makes more money in the back test. That's without considering that we're going to make more money because of the narrower spread. So it's a win-win. We're going to have a look at that next, and also the walk forward optimization on the stop loss value. And if you like this sort of strategy, you should probably download my 22-page Beat the Markets strategy guidebook. And it's got 3 more strategies, a little bit like this one, algorithmic trading strategies, and they're you, the viewers, favourite strategies of mine. So if you use the link down below, you can get that completely for free at the moment. And if you're enjoying this video, please do me a favour and hit the thumbs up button now. Let's go and have a look at that strategy where I've reprogrammed it to enter 15 minutes before the market closes. So we can see in this workspace, we're looking at a 15-minute chart, and I've reprogrammed so we're entering at 16:45. we're using that same 350 pip stop loss. We're now making more net profit, $85,000, and the equity curve looks very similar. And we're going to avoid that larger spread. So like I said, it's a win-win entering at 16.45. And I did actually test anything between 16.15 and 16.45. It does work well. So if you are trading this strategy manually, you haven't got to panic about entering the market exactly the right time. Next, let's have a look at the walk forward optimization. We've got two charts in this workspace. The top chart is the same strategy as we just looked at. However, the data only goes back to 2012 because that's when I can start the walk forward optimization. By the way, if you'd like to know how I do the walk forward optimization, I'll leave a link to the video which explains exactly how I do that. So have a look at that afterwards if you want to learn how to do that. So both charts are from January 2012 through to December 2021. Let's just refresh what the equity curve looks like using the fixed 350 pip stop loss, making 58,000 over that time. And if we're using the walk forward analysis, which means that the stop loss value changes every year depending on which one was best, we're making less net profit, which is often the case with walk forward analysis, and the equity curve is similar, possibly slightly worse down in these early years, but nonetheless still a nice uptrending equity curve, which is nice to see. So there we have it, a reversal type strategy for the daily chart, which works okay on euro dollar, thought up from an idea originally designed to work on 5-minute bars on the S&P 500. For the sake of a few hours programming and testing across some Forex markets, I was able to come up with something that's usable. Interestingly, it didn't perform particularly well in 2021, the most recent data. However, I expect that's just a normal strategy drawdown, rather than the results of curve fitting or over-optimization, because we've hardly optimized anything on this strategy, just that stop loss. But you never know. The pattern may have just stopped working. That edge in the market might have disappeared. And that's why it's so important to monitor every strategy that you're live trading, because they can and they do stop working. And why it's also important to trade a collection or a portfolio of strategies across different markets to help with diversification too. Anyway, that's all for this video. Thanks for hanging around to the end, and I hope you've enjoyed it and perhaps learned something. And until the next video, this is Jared Goodwin, and thank you.